All right, welcome back. There's just 3 minutes to go for the pre-open session. Anuj is here with what he is watching, apart from all that is happening at Twitter. Anuj, good morning.
Morning. Yeah, I mean, amazing, right? The revolution which is happening there. And interesting, the morning tweet by Elon Musk, how to make a small fortune in social media, starting with big fortune. That's what you say about trading, right?
We were talking about that. I mean, it used to be the airline, right? How do you make $1 million? You start with $1 billion and start an airline.
Yeah.
And now he's transposed that to a social media company.
I think it's just a case of, where maybe, obviously he's the world's richest man. So, sometimes you think that, you can do anything and everything and it will turn out well for you. And maybe your ego gets in way, but, clearly, this is something which he may not have envisaged. This is how things are going to pan out. But anyway, let's talk about the markets. One thing which stood out for me was the sharp recovery in US market, because when I was sleeping, the US markets were down quite a bit, but there was a sharp recovery. And Indian market had closed at lows. So in that sense, there's going to be a bit of a sentiment uptick today. But there are no triggers. So as such, focusing on individual stocks, I think, is better. The bigger trade might happen if Brent starts to slip below 90. I think that will trigger algo trades on the bank Nifty, on the dollar rupee. I think that's something that you've got to keep an eye on. If you look at the Nifty charts over the last few days, one thing is very clear. The lows and the highs are beautifully placed. The average of the lows is 18,300. The average of the high is somewhere around 18,410 thereabout. About a 110 point range. So what's working in this market is buying at 18,300s, roughly 18,300, and selling at around 18,400. And that's what the options data is also indicating, with big call writing at 18,400 to 600 and put writing at 18,300. Again, the index to focus on is the bank Nifty. That's been the strongest index. And with the way crude is behaving, if dollar rupee starts strong, I think, or rupee starts strong rather, my sense is bank Nifty could lead the rally once again. 42,200 obviously is the base. Above 42,650, there's massive expansion for the bank Nifty going by the options data.
Okay, Anuj, thanks a lot for that. This Twitter, what's happening right now as we speak, the Twitter headquarters, is something phenomenal, right? So there is a person who was in charge of managing badge access at Twitter offices, and he was laid off, and he just tweeted saying that Elon called me again to come back to help them regain access because they locked themselves out of the office. So, I mean, it is bizarre all that's happening in the Twitter office, but it's entertainment, I guess, for everyone else.
And that's why I guess, as Musk himself says, daily usage is all-time high, right? Because I mean, you can't just keep your eyes off what's happening, because it's unfolding minute by minute. Something about Twitter on Twitter. So it's all there. All right, now Chandan Taparia is with us, derivative and technical analyst at Motilal Oswal Financial Services. Some F&O trades as we start another session. Thanks very much, Chandan. How are you looking at things? How are things set up?
Good morning, Prasant. Happy Friday, and thanks for having me. So talking about the Nifty, it has been consolidating in a range from last 4 days. It has been moving in between 18,280 to 18,442, and comparatively, we are in the lower VIX scenario where measured trend is up, but measured momentum is missing. But the good part is the weekly chart setup is clearly forming high rise, high lows, and indicates that base of the market is shifting higher, and that's why we have potential to hit the new lifetime high and move beyond the same. So we will continue to be with buy on decline stance in the Nifty with support of 18,282 and looking for an uptick to us 18,605, and that is the lifetime high for the index as of now. Similarly, if you talk about the Bank Nifty index, the Bank Nifty is comparatively outperforming the Nifty index. It is every day hitting to the 52 weeks or the new lifetime high. Here we have seen that selective banking, private and PSU stocks are doing well. So we have more potential for Bank Nifty to head to higher zone. So 42,000, 42,250 is the major support area. And with the support, Bank Nifty has potential to head to us 43,000 to 43,500 level. So in both indices, we are positive setup, even lower volatility with a stable put call ratio, and better FIs long short ratio are also supporting the bullish sentiment of the Indian market, along with positive support from the global indices. So again, in this market, we need to be stock specific, and selective stocks are doing well. So to name the first, that is buy on BEL. We have positive on most of the defense name, whether you talk about BEL, HAL, Cochin Ship, Mazgaon Dock. So first, that is buy on BEL. This stock has seen 7 to 8% open interest in the long side in this week. Entire sector is doing well, holding well above 50 DMA technically. So recommending to buy with a stop loss of 108 and expecting it to move to us 117 level. Second trading idea, that is from the capital goods, buy on LNT. Larsen has given a breakout from his pole and flag pattern. So nice breakout led by put writing clearly indicates that 3 to 5% rally can be seen in this heavyweight. So recommending to buy with a stop loss of 1995. And here we are setting the target of 2100 to 2110 kind of level. Last trading idea, that is buy on Cummins. Here also we have given a breakout. And the important part is that huge short covering was seen in this counter. If I look at the last week, open interest fallen by 14%. In this entire series, the open interest fallen by 25%. So this is the case of the short covering and addition of the long build-up. So expecting the rally towards 1435, and one can buy Cummins with support of 1355 levels.
Okay, thanks for that, Chandan. Wishing you a good Friday ahead as well. Appreciate you joining in and giving us your thoughts. Well, let's move on. Sigma SGS Technology, they posted a solid set of numbers. The revenues were higher. Growth was seen as well across segments. The order book, well, that looks good as well at around 1,700 crores. But the company in the conference call, well, they said that demand from European market is subdued due to macro headwinds. To understand how the second half of the year is going to shape up, we're joined by Mr. Sandeep Tandon, the executive chairman of the company. Good morning, Sandeep. Thanks so much for joining in. Well, you had a blockbuster listing, so now the numbers are going to be very, very crucial. First half of the year has done pretty well. There are some challenges, as you said. You've done around 850 crores odd. Normally, the second half of the year is better, right? So what kind of a number can you end at for this year? I think you were talking about 1,700 crores odd. Can you better that number? And margins have improved as well. Do they get to around that 12% odd mark? What's the steady state?
So I mean, I don't want to give any forward-looking statements. I can only give macro statements that are there in the industry, right? We are seeing tremendous tailwinds from support from all our customers and new customers also in the last 18 months. We've seen a lot of interest in India as a second source to China for most of the MNCs. And I mean, we've been in this industry for long years, and we were, the first pioneers to have made electronics out of India for the US markets for customers like IBM, Compaq, Dell. So I have seen this cycle, and never have I seen the kind of interest India is gathering. So now the support from India plus our experience is creating a lot of RFQs and interest moving forward. I mean, this business is not a quarter-on-quarter business. You have to look at it a little more long-term, maybe 5 years. This is a nation-type building business. And we are seeing a lot of interest, which I've never seen in my past, right? So I like to say this is like the Y2K moment of our IT services business. So this for the manufacturing business, the whole perfect storm has happened to push our numbers up. Quarter on quarter, of course, there are a lot of challenges with supply chain still very, very erratic. Even if we get orders, getting the materials in time to be able to service those orders is still a challenge. Of course, it's getting better, but we continue to, lead from our strategy of being very focused on being a partner with our customers, where we can, add more value, design as well as manufacture for the customer. So theoretically, our margins are higher, but when you're growing, right? When you're growing, you don't have the same yields as a steady state situation.
Got that.
So that's yeah.
Yes, I mean, it's great to hear that, this is a Y2K moment and you're seeing a lot of potential. In fact, you do have a lot of competitive advantage, right? I mean, you have large customers like HUL, TVS, you have very strong wallet share across companies as well. And I was going through the trajectory of your margins. In the last 5 years, your margins have gone up from, I think, 6% way back in FY17. And now you're almost a double digit. In Q2, you did about 10%. Do you see more scope to improve your gross margins? A, because input material prices have corrected, but there's also, there's operating leverage, there is your growth in the ODM business, and there's benefits of the PLI scheme. How much do you think, I'm not asking for numbers, but is there a big margin headroom for you?
So there is a mix, right? When you're growing, you can't expect to make the same kind of margin at steady state. So I love to say yes. I mean, our teams are all activated to drive superior margin. And when you grow, of course, you get the scale benefits. Those are definitely there. But when you're growing with new product assemblies, and you don't get, like, for instance, last 6 months, right? We put up 2 new plants. I mean, the revenue from those plants is minuscule, but the full staffing has been done. So once we start seeing stability as we grow, but the growth is still very real, we will start seeing definite margin improvement. But I don't want to give markets elated numbers and say this is totally doable. We have to continue to strive. It's a tough business to it's a services business, so we have to work very, very hard.
The big chunk for you, Sandeep, hi, good morning, is printed circuit board assembly, right?
Right, that's the biggest.
It's almost 80% of your business.
Absolutely.
And is that, I mean, are there any challenges at all, or more and more of this stuff is getting outsourced? I mean, is it? We are hearing from companies in the US, for example, a lot of talk of onshoring. I mean, do everything in house, right?
Yeah. So definitely that's a trend, right? They want to be as close. This China scare has really shaken up everybody, right? And the lot of interest is to be near shore or onshore or a different supply chain. So these are ways we also win in a way, right? So it's not one large factory that you're competing with in China that has completely owned the thing. So you actually can add, when you do nearshoring, PCBA actually gets made by us and the final assembly is done in the US near the customer. So it actually adds more value for us. So that's not a competitive negative, it's a positive.
Now, how does it add value, Sandeep? I mean, the best would be if you manufacture here and export, right? But if you have
correct. So no, we manufacture. That's what I'm saying. So PCBA is a input material for the final assembly. For instance, we have a customer in Germany who makes industrial washers, right? So we make the PCBAs.
Right.
They do the assembly with the mechanical parts in Germany.
Okay. All right. Sandeep, getting back to some numbers, as you said, it's a Y2K moment and you've added some capacity, right? At peak, I think you can do what, 3,500 to 4,000 crores, taking into account this, this capacity that you've added. Are we getting that correct?
At peak, that's correct.
3,500, 4,000 crores, right? So let's not talk near term then. When do you get to this number? If things are looking so good, Sandeep, we need a couple of numbers from you. Near term, we're not.
I've been advised that I cannot give numbers. So yes, it is totally possible within the next 2 to 3 years.
So by FY25, you will be, in that vicinity of around 3,500 to 4,000 crores of revenues. We've got that one. What about for this year? The second half of the year is better. Are you with me on that one? Normally it's better. I'm just looking at your numbers for the last few years.
In the past it has been better. Yes.
So you've done 850 crores in the first half. The second half of the year will be a little bit better, going by your order book, going by business. So we're working in the vicinity of more than 1,700 crores at least for this year.
Yes.
And margins will get better as well from here?
Yeah, they should. I mean, they should get better. Yeah.
Manage a couple of numbers.
I don't know what.
I know it is hard. I mean, I understand that it's not easy.
I've been told, my lawyers have been told, don't say anything. I'm like,
no. We're just
trying to get a sense from you. We're just trying to get a sense from you on which way things are headed. This ODM business.
This is my first time out, so
sure,
please bear with me.
Sure. This ODM business, I just wanted to understand. In the last four years, your compounded growth rate has been a bit slow. I mean, it's been in low single digits, about 3 to 5% for ODM particularly, right? Now there is this PLI scheme that will perhaps give you an edge against your international peers. On steady state, you think can you get to double-digit compounded growth purely for ODM? And what is the kind of capex that you plan to put on board? I think the last number I have is about 150 crores that you've done in the last between FY22 to FY27. I think that was what you had outlined. Would you look to change that in any way?
So we'll probably in the second half also we'll manage to do about the same capex this year. We are locating we are in the process of finalizing a new facility also, so that as soon as that is there, the capex will go in. And your previous question was on ODM, right? So ODM growth is dependent on approval of the products, and it takes a longer time. So the cycle of a ODM is a lot longer. And what I told you, right? Since this is a Y2K moment, there's a lot of existing stuff that is coming to us that, hey, we are building this X factory, we want to move. Can you take it? So, I mean, I'm not going to say no to business, right? So when ODM products are what we call new product introduction. So you work with the customer, design the product, get the approval, and then build it. So we are not, when you get 40% growth, you can't manage with everything being equal growth. So our goal is definitely to continue that partnership, build on ODM, but that, it's not the same path, because like I told you, it's the interest is very high right now.
All right, Sandeep, we wish you all the luck. Thank you very much
for joining us. Thank you so much.
Great having you with us here, as always. Thanks. Well, Mitesh is with us with a quick check on how the pre-open is shaping up and trades right now. Mitesh.
So I think, as I said, Prashant, we'll not rush into buying the index if it opens with a minor gap up. But I think broadly, The idea is that if it starts getting past 18,450, we'll take a long. Otherwise, on the stock side, Excite is something which I would recommend buying the stock at 183 for a first target of 196.
Okay, all right, Mitesh, thanks a lot for that. By the way, let's focus on a couple of other stocks. You know, Kotak has written a note on NMDC and they've upgraded the stock to buy with a target price of 130 rupees. Remember, yesterday we told you that they've cut pricing for the month of November itself, but they believe that this is an attempt to revive volumes, which should be the case. They say that both domestic as well as seaborne prices, that's iron ore prices, they are bottomed out, and they expect that this to have upside from here on. So iron ore prices itself, they're based out and they'll move up domestically and internationally. They see a strong case for NMDC to re-rate from here, post the demerge of the steel plant, and a few reasons they've given is improved capital allocation. Remember, most of that money was going towards that 20,000 crore steel plant. That's point number one. The free cash flows will improve from here on. And also, since they'll have a lot more money, they could pay out higher dividends as well. So put all this together, Kotak, they're optimistic on NMDC's prospects from here on. But Ekta is back with us to tell us about Glenmark Pharma and Glenmark Life Sciences. Ekta.
I don't think we can hear Ekta, so we'll just try and get back to that in a bit. But the pre-opening rates, right, have settled a tad bit higher. So it looks like it's going to be a green opening. Asian Paints, Kotak Mahindra Bank, Apollo Hospitals are a couple of stocks that are doing pretty well this morning. And in the broader markets, it is names like Nykaa that's up about 2.5%. Let's see how that plays out. NMDC, as Nigel was also pointing out, and a couple of other names in the banking space that are doing pretty well today. All in all, for the week, it hasn't been too bad a week for most indices if you look at it. I mean, largely flat for the headline index. This month, the month of November, the Nifty is up about 2% So we're very close to those all-time highs, but yet a bit far away. And for the week, the mid-caps have underperformed a tad bit. So, let's see, just about 17 seconds left. The first take on the index will be with you very soon. Do watch out for names like Tata Motors that could be under pressure because of all that's happening in UK. And Hero MotoCorp, M&M are just a couple of other stocks that are a tad bit soft at the moment. But here's the first take on the opening bell. The last trading day of the week, and not a bad opening at all. The Nifty is up 40 points. The mid-cap index is up about 100 points and the Sensex is up 130 points. Leading from the front is the Bank Nifty, up 100 points straight off the back. Kotak Mahindra Bank is up about 0.6%. Followed by a couple of other banking names. You have Asian Paints, Apollo Hospitals, UPL, BPCL that are all trending in the green right now. And Adani Group stocks are doing what they do best, that's rising. Tech Mahindra, HCL Tech from the IT space also looking pretty good. So what's on the downside then? You have Hero MotoCorp that's down 0.3%, so is M&M. Some profit taking there. Tata Steel, Grasim, Sun Pharma and Dr. Reddy's are also a tad bit in the red. Now the market is losing ground, so it is kind of volatile all over the place really for the index. Nykaa in the broader markets is up almost 5-6%, and Nigel will talk about that. But for the headline index, holding steady at around 18,370 with some gyrations, but mild green tick is what we're seeing.
We'll take green for starters. Yesterday we ended at the low point of the day, so a couple of stocks deserve special mention. Vedanta, in the next few days, they're going to be meeting to pay dividend. Remember, we told you yesterday that they received dividend from Hindustan Zinc. That's what they'll receive. And normally there's a pass-through clause that comes in there, so their shareholders are hoping that it does happen. NMDC, Kotak note, that's the one that's fueled the stock higher. They believe that things have bottomed out and things will improve from here on, so it explains why the stock is higher. A couple of other names, Nykaa, you had a large trade that took place in pre-open. So that one, in fact, is spiking up. It's up close to around 5% from yesterday's lows. The stock is up more than 10%, actually. Jacket, that JTKET, well, that stock is, moving higher as we speak. And HCC as well, there's a debt recast out there. Yesterday, in fact, there was a large trade that took place. In the last few days, there have been a couple of those lenders that have been offloading some of their stake. HCC, so that one, in fact, opens up with a gain of close to around 3%. It's only a 16 rupee stock, I think. But Hindustan Construction should come up 4% as we see. Prashant, what else?
All right, so it's a good start, right? 45 points on the Nifty. Let me just, by the way, market breadth is overwhelmingly in the green at this point in time. So it's not a problem at all. 3:1 in favor of advances. This is quite different from the kind of open we've seen in the last two sessions when, the market breadth was more in favor of declines. So let me just take a quick look at the other gainers, apart from what's already been mentioned. So Zomato is up about 1.7% at starting higher. Policy, Bazaar is up 3%. So, these, and of course, we mentioned Nykaa already, which is up 4% or so. So these three names are looking good. So Nykaa has actually, I'm assuming, gotten great demand. And that block has gotten done, as we highlighted earlier. So well managed, the entire thing. And so that's up and about. Godfrey Phillips is another one which has had a vertical one-way rise recently. It's up another 2.5% to begin with. What else? Blue Dart is starting about 2% higher. There is CMS Info, which is up about 1.7% in the green as well. The Nifty is coming off a little bit. It's up 20 odd points now. We'll see. Timken India was locked up 20% yesterday. It's starting 2% lower, but there's not very much on volumes, at least at this point in the day. Hoodco is another one which is down 1.5%, but it's far and few in between. The momentum is, of course, with, at least this morning, stuff which is up on volumes in the broader market space. So 25 points, 18,366 is where the Nifty is starting at. Overall, I mean, it feels a bit quieter as compared to the open in the broader market we've had the last 2 or 3 sessions now. Our market master of the day is with us. Nilesh Shah is Managing Director of Kotak Mahindra Asset Management Company. Nilesh, welcome back on the program. Thank you very much for your time. It's been a while, so good to see you. There are two things. Oil is now under, last night it fell under $90, so it's a far cry from where it was, and that's perhaps the most important macro variable. But on the other hand, you've got, commentary from Fed officials, etc., again saying, there was one particular gentleman who said that, the terminal rate should be somewhere between 5 and 7%, which is, how do you see this kind of pan out as we head into 2023?
So I think, Prashant, market is used to Fed walking left and talking right. Most Fed officials have been doing this quite consistently. Even Fed's press release versus Fed chairman's press conference were into opposite direction. Press release was dovish. In press conference, he highlighted that terminal Fed rate will not be 4.63, but more towards 5%. He highlighted rates will be higher for longer. And he also highlighted if he has to make a mistake between keeping rates higher and creating recession versus keeping rates lower and not controlling inflation, he'll rather make the first mistake. So I think market is now well used to Fed talking left and walking right. It will be fair to assume that Fed is trying to buy credibility. They have been behind inflation for a long period of time. Now they have to make statements to buy credibility, but at the end of the day, they will be driven by data. Whenever they believe inflation is under control, they will be then focused on growth. And clearly, what data we are getting from US in terms of economic numbers, they are not that good. We believe 1 in every 6 American household is behind in payment of utility bills. Now, with that kind of scenario, I doubt Fed will have a lot of leeway on keeping rates higher for longer.
So what do you do here in this market, Nilesh? We're virtually at all-time highs. The momentum has picked up. FII buying has come back in a big way. Do you think we'll spend some time around these levels? Is it a pause that you're looking at purely because of the global concern? Or do you see more legs to this rally now?
So, Sonia, from a valuation point of view, we are now above our historical average valuations. This is kind of standing out in the world where most of the markets are trading way below their historical average valuation. It's difficult to understand FPI behavior. They have been selling when valuations were cheaper and they have been buying when valuations are expensive. From a valuation point of view, this is not the market which is very attractive. We are in marginal premium category. So you have to be stock specific. You have to keep dry powder for accumulating in case correction comes. And you have to be a long-term investor because now you are not investing for 6 months, 12 months, 18 months. You are invariably taking a 3-year and 5-year view.
Hi, Nilesh. Good morning. Nilesh, I listen into your advice, and for my kids, I don't miss a single SIP. I'm keeping it going, and I'm looking at it for a longer-term horizon. The problem is some part.
Thank you so much.
Before you pull me up on that front, but my question to you is the fear is that maybe some part of this domestic money gets pulled back. Because real estate could be an attractive investment, or maybe some of these bonds, maybe not top paper, but maybe some of that paper is offering 8, 9%, 9.5% odd. I wanted your comment on that. I'm keeping the faith, I'm reiterating. But Nilesh, do you see this as a bit of a threat? And what's your comment on it?
Undoubtedly, Nigel. I think retail investors have matured way beyond foreign institutional investors. Mm-hmm. They have been buying when markets are falling and valuations are cheap. They have been booking profit when markets are rising and valuations are expensive. Collectively, as a retail investors, if we see their SIP flows continues at about 13,000 crore a month, but they have been booking profit and investing on a lump sum basis to ensure that in a falling market, there is SIP plus subscription flows. And in a rising market, there is SIP minus redemption flows. So I think retail investors have become fairly mature. They know what asset allocation means. And whenever they believe risk-adjusted basis, debt, real estate, or commodity markets deliver better return, they will certainly take profit from equity. So I don't expect that mutual fund flows will always be unidirectional, going one way up. We will be driven by what kind of flows come to our kitty. And that's where I do see retail investors behaving in a fantastic manner. They manage their asset allocation far more than what they were doing 15, 20 years back.
Nilesh, just to take that asset allocation point forward, I mean, in a previous life, you were on the fixed income side as well, many years ago. Are yields attractive? Somebody was making this point that, I mean, these are not bad fixed income rates to lock yourself in for the next couple of years. If you don't have exposure on the fixed income side and you want to balance, asset allocation, would you agree with that, or you think yields are headed even higher, so one should wait a bit more? What's your sense?
If you are taking a one-year view, then certainly yields can go higher and probably impact your return. But if you are taking a 3-year view, then this is the level to invest into. Yes, in the short term, there could be some pickup in yield as US Fed, sets the direction. But we believe there will be ultra V kind of interest globally. What happened in Japan, where central bank for 30 years is keeping liquidity high and interest rates low, will happen in European Central Union, will happen in United States of America, will happen in United Kingdom and most of the Western world. A $30 trillion debt, 1% interest rate movement means $300 billion increase in interest cost. If interest rate goes up indeed from 0.25 to 5 to 7% as Fed is talking about, that's increase in interest cost of more than $1 trillion to $2 trillion. I don't think so American budget has that kind of flexibility to provide for that interest rate cost. Japan today can manage 225% debt to GDP ratio only because interest rates are zero. If interest rates goes to 5-6%, Japan will become bankrupt. So there will be ultra V kind of interest rate movements globally. Central banks will raise interest rates when inflation is going out of control as it is today. But they will soon start cutting interest rates in order to ensure that their government and country survives. Keeping that in mind, if you are taking a 3-year view, this is the level of yields to lock in. If you are taking a 1-year view, then yes, you can try to time in. My simple recommendation will be do STP in duration fund over next 3 to 4 months. There will be far more clarity by March 23 on interest rate scenario.
Within instruments, you already gave us the STP option. Should one look at corporate paper, slightly higher yielding instruments, etc.? I mean, just to dig into that a little deeper.
Prashant, my view is that you follow your risk profile.
Okay.
If you want to take risk, it's far better to take risk in equity than in fixed income.
Okay.
In fixed income, always believe that return of principal is more important than return on principal.
Got it.
Okay, got that. By the way, the market is very, very quiet right now, but it's still the PSU banks that are gunning from the front. Union Bank is up 2%, Bank of Maharashtra, Bank of India, a whole host of banks actually both PSU and private, central bank, all doing well. Nilesh, a quick comment on banks. Do you think it's getting to be a bit of a crowded trade now, especially PSU banks, or do you think there's lots more to go on the upside?
So this is, Sonia, a very, very tricky scenario. Normally, experience teaches us that whenever there is a consensus, it is generally on the wrong side. There is always a surprise down the road which comes and impacts consensus. We have seen those kind of crowded trades in technology, media, and telecom in 2000. But this time on banking sector, fundamentals are supporting valuation. NPA levels have come down. As interest rates have gone up, margins have expanded. Liquidity is getting a little bit tighter, but it's not that tight that your credit growth or deposit growth will get impacted significantly. More importantly, valuations have corrected significantly over the years. So I believe it's a crowded trade, it's a consensus trade, but valuations today in banking system are not as expensive as bubble valuation in other sectors. So maybe there is some room for rally in banking stocks, both private as well as public. But one needs to be cautious that this is a crowded trade.
Okay, all right. Nilesh, one place that was very crowded was New Age, but that was a long 12 months back. Today, in fact, that's in minority, but there's plenty of supply that's there. Any view out there? Some of those businesses, well, they're well-run businesses. The problem is on valuations. But post this price correction, do you think some of them are getting to that, that zone where you want to have a look into it?
So, Nigel, this was a crowded trade from private equity point of view. It was not a crowded trade from a public market point of view.
Absolutely.
We really don't understand how this companies work. There were not many precedences in public market. We ourselves were learning how to understand these companies, how to, prepare business model for them. And all of us probably invested small sums of money in order to keep a watch and in order to learn. Now, I believe over last 1.5 years journey, we have accumulated some knowledge. And I think public market investors will start differentiating between men's and boys. There will be new age companies which will be rewarding investors over a period of time from this level. And there will be new age companies which will still destroy shareholder value from this point of time after 50, 60, 70% correction. So men's will be separated from the boys. People will have to bet on their conviction. There will be more volatility in new age company than other sectors or other companies.
Okay, all right. Nilesh, we will leave it at that. Have a great weekend. Thanks a lot for joining in on the show. Let's move on and talk about the real estate space. Sobha is on our radar after its Q2 earnings. Volumes were flat compared to last year, but the company has clocked in its highest ever quarterly sales value and collection. Sobha's average realizations have also increased 12%. And another positive news, the declining debt trend also continues. Jagdish Nangineni, the MD of Sobha, joins us now to talk about that. Mr. Jagdish, thanks a lot for joining us. I wanted to ask you a little bit about what the volume trajectory could look like in the second half of the year. What's the guidance for the full year and what could the growth be?
Morning, Sonia. Thank you for having me on your show. Yes, you're right. The first half has been really good for us with probably the best ever volumes and also the value. The realizations also have increased by close to 12% in the first half. The second half also looks very promising. We have a few launches planned in both in multiple cities, including Gurgaon and Hyderabad and in Bangalore. So those launches and current sustained volumes from the existing inventory that we have looks promising for the second half. As such, we don't give guidance, but we first half we did about 2.7 million square feet. So the second half will do probably much better than that.
Right. And Jagdish, hi, good morning. So in terms of the sales value in the all-important market for you, which is Bengaluru, you have retained market share. You are the number 2 player.
Prashant, I don't know if we are number 2, number 1, number 3, but we have definitely been doing much better. First 2 quarters, we have, for the first time in the history of our company, we have done more than 1 million square feet a quarter, which means we have done already 2 million square feet in this financial year. And we hope to do the same numbers in the coming couple of quarters too. So that will take 4 million square feet in Bangalore alone, which will be the highest for us ever. So that's very promising, and that seems to be very sustained despite our price hikes that we have done. So that's very encouraging.
Jagdish, let's talk about the price hikes then. Good to see there's a lot of traction on ground, but pricing will be something that your customers as well as the stock markets will look at very closely. For the second half of the year, what kind of price increases? Have you taken one first in October? And do you believe that prices will continue to increase from here?
There are two parts to it, Nigel. One, the historical last 12 months, it's been very unusual. Most of us, most of the real estate players, including us, we had to take price increases to protect our margins. And thankfully, that didn't hurt our demand. In fact, it's accelerated our demand. Probably one, because of the improved affordability for players like us, much better brand acceptance. So that's very good news for us. Going forward, that's not the limelight of price hikes which happened in the last 12 months or so. We would like to reduce that now. More the things that will come on to play now will be far more local micro market dynamics and probably project specific events. So I would definitely see that there will be improvements in our realizations because we will replace the old inventory with new inventory, wherein most of our cost increases will be baked in. So hence, it's the realizations will be up. Price increases specifically to counterbalance inflation might be largely over unless things considerably change.
Okay. And this volume growth, I mean, in 2.7 million square feet is the sales volume in the first half. You had also earlier mentioned that you plan to achieve a sales run rate of 7 to 8 million square feet over the next 2 to 3 years. But you think you could get to that earlier on? Because by the end of this year itself, you will be at, about 5 to 6 million. So what are we looking at in FY24?
That's right. We would like to achieve 7 to 8 million square feet. We would not like to run ahead of ourselves. We would like to achieve, once we reach there, we would like to stay there. So consistency is also a big factor for us in how we will plan our future growth. So when we can reach there is dependent on several factors, mainly with respect to our ability to bring new launches in both our existing and new locations. So,
sure.
Absolutely,
So to achieve this target,
got
it. To achieve this target, would you look at changing your geographical breakup a little bit? I mean, the Mumbai market is really hotting up, and so many of your peers are getting into this market in a big way. Would you look to diversify as well?
Absolutely. In order to increase the volume, we'll have to increase our contribution from other cities. We are looking at opportunities where we can get this volume growth. See, even now, we are probably one of the most diversified players in terms of geography. We are already present in 10 cities. We are just, this quarter, we have started our first project in Trivandrum. We have significant operations in NCR and Pune, and we're going to start operations in Hyderabad. So these, I think, will contribute higher volumes for us in future. Specific to Mumbai, yes, Mumbai is a very large market. We would like to look at opportunities there, but more focus right now is on our operating locations.
So,
sorry, Jagdish, are there any, is the Kerala project, the Trivandrum project proceeding on track, or are there delays?
We just started, that's the first project that we launched, Prashant, last quarter. And the response has been very encouraging. So we just started the project.
Okay.
So you said that you're looking at the Mumbai market. It's a very large market, but nothing identified just yet. Over the next 1 to 2 years, what could your plans be? I mean, out of the 7 to 8 million square feet, I'm sure you've lined up something from other markets apart from Bangalore. So what would your plans be, if at all, in Mumbai?
Sorry, Sonia, we don't have any specific plans for Mumbai.
Okay.
But however, 78 million square feet, like I said, we are clocking about 4 million run rate in Bangalore. So the remaining, even if there is a growth in Bangalore, the remaining has to come from the other cities.
And can you give us an update?
The other geographies that where we are already present in, NCR is a big market for us, which we have been present for the last 12 years. So there we think that we can add some more volume and value.
Okay, can add more volume in the NCR region. Got that. And your debt has been going down. So you were, at almost 3,000 crores in Q2 of last year. And now you've reduced it to less than 1,900 crores. Further plans of reducing debt?
Yes, Sonia. We have never done this before for a reduction of 11,060 crores in the last 8 quarters. I'm sure there is a change in our DNA, the way we look at our business. Cash flow generation has been our mantra, and going forward also that will be our main focus. Now the focus will also be on growth and how we allocate this incremental cash flow that we will generate.
All right. Thanks very much, Jagdish. Appreciate you joining in and running us through all of that detail. So that's the management of SOBA with perspective. The Nifty, by the way, is down, 30 points now. We're at 18,310. So there is a bit of a cut. Let me just see if we've got, by the way, market breadth, which was overwhelmingly in favor of advances, almost 3:1. That is also kind of closed in. So I think it makes sense to look at a few things which are down sharply. Mazgaon Dock, if we can have that up, a huge outperformer that is down about 4% with volumes right now. Look at Mahindra & Mahindra, that is down 1.6, 1.7% on volumes. Timken, 20% higher yesterday, 4% lower. HAL is another one. So some of these defense names, HAL is down 1.6. RVNL was down yesterday sharply. IRFC is down 3%, again on volumes. Now these are interesting names which have recently done very well. Container Corporation is down 1.5% on volumes. Dixon is down about 2.25%. We had a company in the same space earlier, Sirma, which of course we spoke with. Cochin Shipyard is down about 2%. So I can spot at least 3-4. Garden Reach is down 2.25%. So there is some amount of profit booking which is coming up in some of these defense names at this point. Manappuram and Muthoot, both gold financiers, down between 2 and 1.5% right now. So that's a broader market for you. 30 points lower on the Nifty, so flattish, 18,311. We'll take a quick break. We are back with the management of Cummins India. They'll talk to us about their second quarter earnings and the future. Ravi Jhakar, Chief Strategy Officer of All Cargo Logistics, was also with us to chat with us about how things are looking at their end. Stay with us.
Hello everyone, I'm Ramesh Damani, requesting you to catch a very special episode of Wizards of the Street, where for the next 2 weeks, we are remembering Rakesh Jhunjhunwala. The story of his life is the history of modern Dalal Street. Catch it all on Wizards, only on CNBC-TV18.